The token is just a token. The issue we're talking about here is the money that the investors put in the accounts, and they need to take them out. That's the issue we're talking about. So they would stake their tokens, whatever it is, Ethereum and Bitcoin and any kind of token, and expect that they can withdraw them at any time. But that's not the case. And that is why there was a panic. People did not know what to expect. So when you are in an uncertain time and you're reading Twitter, which it seems where all the news is happening, then you're going to make a move, which is simple. I want my money back. And so Alameda Research was loaned money from those investors and put into their company, unbeknown to them. And then they did some kind of alchemy, and who knows what happened. Maybe they've made some bad bets, who knows? But that money did not return.
Okay. Isn't that sort of the model that traditional CeFi banks operate on? You have deposits that you give to your bank, and the bank lends them out to other either depositors or creditors or other firms. I mean, this is not a new model, correct?
That is correct, but here's the one main difference between the two models that you're mentioning. One, the model of a bank has regulators who are reviewing on a monthly basis the financials of the company. They have circuit breakers. So if they do not meet the net capital rules, there are methods for stopping the losses. And there is FDIC insurance, which is an insurance program where each account holder is insured up to a certain amount of money, which is about $300,000. Now, so you could argue, yes, it's similar, but in the case of FTX, there is no insurance, number one. Number two, there's no visibility on their balance sheet. A bank, you can look at their balance sheet at any time. Anyone can look at a bank's balance sheet. But here, there's no visibility. No one can see what's going on. So I would argue that should FTX been regulated, this would have not happened. They would have not allowed these intercompany transactions, which are between two parties who are in control, which is FTX and Alameda Research are controlled by the same shareholder.
Okay, so let's come back to that. Now, what do you think is going to change in the realm of regulations around cryptocurrencies following this case?
Well, I think it's a clear classic big explosion that will have everybody feeling that regulation is necessary at this point. Most of the crypto world does not want regulation. That has been very clear. SEC is trying to convince Congress to give them more resources so they can build a certain amount of regulation for the crypto. There is regulation right now for securities and for banks. That is very clear. There is no dispute. But the question, how does it apply to crypto? And that is going to be what the regulator is going to work on. And I think this is really the defining moment as to when regulators are going to be given the power, political power, and investor protection power to come in and start demanding that these companies do regulate themselves. So here's how the bankruptcy works. It's not very complicated. The secured debt comes out first, right? Those are the banks, the lenders, anyone who has loans with the company, they come in. And then the big mystery is, how do you treat the account holders? That is a mystery. Why? Because these are not accounts. Now, in a bank, a real bank, those accounts are a liability to the company. So they have to be repaid first before you pay the shareholders and some of the debt holders. But in this case, it's not clear. It's not written anywhere that says what happens to these accounts should the company liquidate. And that is a big mystery. And some people are talking that these accounts are going to be considered common shares. Who knows? It's very hard to tell.
Are you concerned about the spillover effect onto other cryptocurrencies that may be linked to FTX and Sam Bankman-Fried? Solana, for example, was a longtime favorite token of SBF, and that's down significantly this week as well. Is that a particular case that you're worried about? Is this the beginning of a larger contagion effect onto other cryptocurrencies?
I think it will have a major effect for a period of time. We're not sure how long. the thesis of the cryptocurrency world makes a lot of sense. There's a lot of technology here, a lot of innovation that needs to be preserved. However, it always comes down to the same issue. It needs regulation, because what happened today is a classic run on the bank. It needs regulation so that investors are protected. But it doesn't mean stifling innovation. It doesn't mean saying that crypto is bad or tokens are bad. No, it means how do we create a situation where we can get the confidence back from investors that this is a great opportunity financially for them. But until these questions are answered, you're going to have more of these, I would say, big events that can scare people away. And the supply demand model, if people are starting to sell, then the price goes down.